The Federal Reserve is at war.
The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
To fight inflation, they have raised interest rates, eroding the value of U.S. Treasuries and mortgage bonds, which are key assets for banks.
Many called it the backbone of Silicon Valley. This is the biggest failure since 2008.
Signature Bank marks the third largest bank failure in U.S. history.
In response, the FDIC and the Fed made unprecedented guarantees to bank depositors, but this wasn't enough to diminish concern in the market.
Moody's downgraded the entire U.S. banking system from stable to negative and warned there's more pain ahead for the sector.
The ultimate level of interest rates is likely to be higher than previously anticipated.
Banks are the canaries of the economic coal mine. When they start dropping dead, a cloud of uncertainty looms. This is especially scary for folks invested in the stock market, because in order for the businesses they're invested in to remain successful, those businesses need stable banks. What you expect to see in this case is a classic flight to quality, where money leaves the place that suddenly looks really unstable and scary to the place that looks really boring. It doesn't pay high returns, but at least it's safe. More money going into bonds increases the price of those bonds, which in turn reduces mortgage rates. On paper, mortgage rates should have fallen dramatically, in a hurry, but what we have seen is not so cut and dry. Before covering what rates have done over the last couple weeks and what they're likely to do in the future, I want to take you back to high school physics class for just a moment. You may recall being told to run certain equations in a vacuum. By eliminating variables like wind speed, you could run mathematically perfect calculations for something like, say, how long it would take a disk to travel to a target when thrown at a certain speed. But the true physics of flight governing how a disk is thrown, with real-life wind and spin and angles, it's a much more complex affair, much like predicting the movement of money via macroeconomic theory.
The 30-year fix just crossed over 7%.
On the day that the Silicon Valley Bank collapsed, you can see a quarter-point drop, which carried over into another quarter-point drop the following Monday. What followed is an up-and-down pattern, rather than a straight-up flight to quality. Mortgage rates were pushed up and down by the winds of competing ideas and powers in the market. Concerns over banks failing and general uncertainty function like a flight to quality tailwind, pushing rates down. The headwinds in this case, lifting rates higher, involve the fact that the Fed intends to do what it takes to win the war on inflation. And the fact that they have promised to backstop failed bank depositors via blank check loans helps to soothe concerns in the market. On days where bank stocks fell, when people had reason to wonder if another bank was going to fail, rates dipped. On other days, no bad news about banks was good news. Perhaps the hasty bailout was just the assurance needed to cool bank runs against these eroding bank assets.
Obviously, at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
By not raising rates by 0.5%, as many experts believed likely before banks started collapsing, the Fed confirmed something akin to a limited ceasefire in the inflation war, which tamed mortgage rates down to their lowest levels of the month. But at the time I'm shooting this video on March 28th, rates are creeping up yet again to a little less than 0.5% below pre-bank collapse rates. So where will the winds take us going forward? Consider that what the Fed has done to cool concerns over bank failures involves something that is quite arguably inflationary. Backstopping banks without the assets to cover their deposits is papering over the holes in our monetary system with more money from the Fed. Is this supply of money never ending? Has the pace they are using to make these repairs stick been analyzed to see if it holds up over time? As long as inflation remains out of control, rates by and large will be lifted by the headwinds of Fed policy. But if more banks fail, you may see windows like the one we're in now, where the rates aren't maybe quite as high as they would otherwise be. As a mortgage consumer, you should expect all outcomes to be possible and make your decisions in the only reality you can know, which is in the here and now. Your decision to buy a home should be based on what you can get for your money today. If you can purchase a home that you can comfortably afford and still have room in your budget to save for the future, I recommend it. If rates come down in the future, you can refinance. If rates go up in the future, you'll probably be glad to have the rate you've got. At First Bank, I can help with your mortgage in almost all of these great United States of America, with the exception of Maryland. Sorry, Maryland. I'd like to be your mortgage guy. Call or text me at the number below anytime. Thanks for watching.